look, there's reality and there's rhetoric, right? And we've got to decipher the two. And we're going to react in real time for our clients, but be proactive. Make sure you're not taking unnecessary risk at this point of all-time high valuations.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, it's Super Bowl week. Do you have a prediction?
I tell you what, Chip, I'm going to be a bold guy, and I'm going to go out and give you the score before the game even starts.
Okay.
0-0.
Boom.
I am hoping simply for an entertaining and good game because neither one of these teams are my team, frankly. I know I have a lot of friends and local folks that are pulling for the Chiefs there.
Want to see Chiefs make history, the first three-peat.
My dad is a pretty big Eagles fan, so I might have to slide and root for them. So I just want to see a close game because that's what makes these Super Bowls. And recent years, they have been entertaining. So, and we'll see how the refs, decide the game in the last 20 or 30 seconds.
I saw an item at the Babylon Bee, the spoof news site, that showed NFL referees taking Patrick Mahomes, the Chiefs quarterback, home from the game, fixing him some hot cocoa, tucking him into bed, and reading him a bedtime story.
Well, it has gotten a little bad and ridiculous. I don't want to spend too much time on this, but I mean, Troy Aikman called it out on air during the AFC Championship game. So, but listen, all the elite players in the NFL get a little bit of preferential treatment. We saw it with Tom Brady, et cetera. It's just the league's going to protect the moneymakers. That's just, hey, it's an economic thing, right? So, but anyway, let's just root for a great game. If you're a Chiefs fan, good luck.
David, I've got my name tag on. I think you're relatively aware of who I am, but we have a lot of guests at Retire Smart this week. It's a periodic seminar that you put on called Tax Mastermind. Just give us a quick rundown on that.
Yeah, I think we have 20 advisors in this week. So we do this, currently we're doing it twice a year just because it's exhausting. But for 3 days, we go about 12 hours a day. It's a very deep dive on how to do advanced tax planning for their clients and for themselves, frankly. And we've never advertised these, yet advisors, kind of the word spreads around the nation. So we'll have advisors from, I think, 16 different states here this week. So, and we love teaching and coaching and helping these advisors give better service to their clients. But we have one gentleman coming back for his 4th time at this mastermind because he's like, every time I come, I learn something new. And he talks like this. He's like, David, this is just amazing. Okay. So my good friend, Tony, but anyway.
Oh, that's Tony Drake, right?
Yeah, absolutely.
Yeah. Well, good. We'll look forward to seeing Tony again and all the participants. I just like noting, David, that people are coming from all over the country to discover our secret sauce when it comes to tax planning.
Well, I was sitting with one of our advisors this past week, Sean Swanson, and he was working with what we call a private network, a private wealth client. This is somebody who's amassed a decent amount of money, over $10 million, and so there's some special things we can do at these higher asset levels. And they were amazed that we were talking about this very mastermind. He's like, "Well, why do you teach other advisors all these competitive tactics?" Yeah. I'm like, "Listen, there are so many people that need our help. I can't hire and train them fast enough. In fact, we've got Scott sitting in the studio, a brand new advisor, just joined us this week, sitting in listening to our studio pitch right now and listen to the show because we keep scaling and adding. And we're hiring more. By the way, if you have any friends in Lincoln, we are actively hiring for multiple roles, including experienced and advisor trainees in that marketplace. But anyway, there's so many people that need help, Chip. We can't do it all. And so, I hate having to turn people away. And I've had to do that in my past because capacity happens. And so we want to scale and train. And if I train other advisors, more people get help. And that's really what it's all about.
Into the news we go, David. To help pay for Trump tax cuts, new taxes on worker benefits become GOP target. That was from CNBC. Those Fritos and Doritos that you provide in the break room, am I going to have to start paying a tax on those?
That is literally what is being proposed by a handful of Republican members in the House. And these are some of the Freedom Caucus folks that, hey, look, we're okay if we're going to extend these tax cuts. And again, we don't know for sure, but I believe it's over a 90% probability you're going to extend what we reference as the Trump tax cuts. But to pay for some of this stuff, to pay for some of these things, they are looking at now taxing what are considered to be almost like fringe benefits for you. If you have a gym at work, they're going to tax that as a benefit. They're going to, so let's just say the national average was $30 a month for gym, and you have an on-site gym, that would now be $30 imputed income to you that you would have to pay tax on. Yeah, we spend over $1,000 a month for snacks in our break room, right, for our 45 employees, and my wife lets me hear about it every month when I get the bill. But it's a nice benefit. We serve the employees what they want, and I'm just trying to make it a great work environment. So we provide drinks and the world's best coffee, and we're not kidding about that, right? Snacks, but all kinds of ancillary benefits may end up getting taxed. I mean, we have a company vehicle we use because we do so many events for our team to drive it. If you drove that home, you would now get taxed on that benefit of taking the vehicle home overnight if I let you. And I mean, this would be very complex to track for companies, especially small employers. Imagine the compliance and the accounting I would have to do. Come around, Chip, how many bags of Doritos did you eat this month, right? And we got to now track this so we can, I'm sorry, we're going to call that bonus. It's going to be $3 less because of the Doritos.
With the crumbs dribbling down my chin.
Yeah, and we have some, we have Cheetos in there. It's a real popular, and we just look at the fingers and we'll know who did it. But anyway, again, we don't want to make the tax code more complicated. We want to make it simpler. So I hate the idea, frankly.
Well, what bothers me, and I love the Freedom Caucus, but I thought that we were going to fund tax cuts by reducing government. What about DOGE? What about the supposedly sinister Project 2025? Why is the government mentality always, well, we're going to reduce this tax, so we'll have to raise some other tax someplace else?
Kind of weird how you just mentioned that. We haven't heard a word since the election of 2025, Project 2025. Yeah. It's like crickets out there. Yeah. By the way, again, Trump keeps playing chess while the others are playing checkers. The latest announcement this past week was he's going to take over the Gaza Strip, and I started joking with some folks talking about, there's going to be a sandals there, all-inclusive resort. And he actually doesn't have the real intention of building up. He's just trying to create some havoc. And by the way, what happened within 24 hours? Democratic senator and representative after one coming forward, we need to keep that money home. We need to take care of the United States before we'd spend money over there. Imagine that. I mean, they don't even understand how he's playing them. And it's like he's playing a piano and giving us a concerto. It's amazing to watch this happen. And again, he's moving so fast. I don't think they can keep up. And again, I tell you, I'm a registered independent. I don't care about party or policy or a politician. I care about the policy, and I'm liking what we're seeing thus far.
A Trump resort package, Gaza by way of Greenland. Yeah, okay. All right, David, actually, you sounded a warning about this a couple of weeks ago. This may be the other shoe dropping. You sent me this item from Bloomberg. U.S. probes if DeepSeek, that's the Chinese AI startup that has caused such a stir. U.S. probes if DeepSeek evaded export rules for NVIDIA chips. This is involving transactions that took place in Singapore. What's going on here, David?
Well, and if you remember, I mean, it was months ago, I went through NVIDIA's quarterly earnings and showed you how many of those sales were happening to what we call blind organizations, shell organizations in Singapore. So those were sold and then backrooted. And of course, we believe that it took a lot more of these GPUs, these chips, to produce the results they did with DeepSeek. However, cat's out of the bag. It's open source and it's already revolutionizing and changing AI. What's interesting is you just saw some big tech companies report earnings this week, and most notably Google. Most of us know that's a cash printing machine. We've actually showed their economics on the screen, right? Well, they spent an enormous amount of CapEx last year, that's capital expenditures, on buying these chips, warehousing. They raised that number by 40% on their earnings call on Tuesday of this week. So they're not stopping because they don't believe it's 100% accurate that they were able to do it with less chips. So they're going to continue to spend. But what I think is interesting is we're starting to see the markets, as I said last week, I think the best case scenario, we trade sideways for 2 or 3 quarters, let earnings kind of catch up with the valuations we have, or we fade. But I'm telling you, these cash cow companies, these tech companies are becoming CapEx companies. In other words, heavy expenditures. Think of a Walmart. Every time they build a new Walmart, how much money have they spend to build a super Walmart? A lot of infrastructure spending, and therefore their margins are less in that type of business. Where these tech companies, they scale and it's just, servers, et cetera. And so they've had great margins. Well, if they have to start doing infrastructure spending, server farms, and chip expenditures, their margins are going to shrink, and their stocks, if they shrink their margins, will not get the lofty valuations they have. So I would just tell you, be very careful with tech in particular, because if those valuations reset like we did in past years with the dot-com era, we did it with fracking companies in the around 2014. I mean, we see this play over and over again. You may see a very big repricing in the market. Again, I don't know for sure, but again, these are the things I'm looking out for.
Up next, it's time for another edition of our game show called Stump David Brooks. It's the creation of financial advisor Jacob Oren. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our guest this week is our resident authority on charitable giving, and he's back with another edition of the game show he invented called Stump David Brooks. David, good luck, and please welcome financial advisor Jacob Oren.
Hey, Chip, thank you so much. Yes, in the studio, we have once again Jacob Oren, one of our financial advisors who's got a passion and a heart for charitable giving. In fact, leads our class on charitable giving, and is in the studio this week to kind of tell us what's going on in the giving front. What's going on?
Oh, man, lots of stuff. So class I'm teaching is going to be February 12th. At 6:30 p.m. It's going to be called Strategic Charitable Giving, and that's going to be in the Midwest Learning Center. You can register online by going to retiresmartnow.com and click the events tab, or by giving us a call. So I don't know about you, but I have been feeling a lot of love lately. Maybe it's in the air, or because the Strategic Charitable Giving class.
Well, it is Valentine's this week.
It's 2 days away, or 2 days before Valentine's Day. So that gave me an idea. Instead of doing our traditional Stump David Brooks, I thought we could make it special. How about we do a Valentine's Day themed Stump David Brooks?
We'll find out if this makes the airwaves or not, but let's go ahead and see.
All right. So we're going to call it Stump David Brooks for the love of deductions. All right. As always, we want our listeners out there to play along. Drop us a line and tell us how you did. All right, quick note. I want to apologize in advance to all of our radio listeners. These questions are going to be painfully cheesy and full of poorly written Valentine's Day puns.
Well, I will tell you, anyone that knows you personally would expect nothing less.
Right. All right, we're running a little short on time, so I'm going to see how many we can get through. David, are you ready?
Fire away.
All right. Nothing says romance like tax efficiency. Ooh, I couldn't agree more. Which charitable strategy allows you to donate assets, receive a tax deduction, provide income, and make a lasting impact? Wow, that's kind of like a Valentine's Day gift that keeps on giving. A donor advised fund. B, a charitable remainder trust. C, setting up your own private foundation. Or D, a poem that says roses are red, taxes are due, don't forget your deductions, or the IRS will too.
Cheesy we go, but we're going with B, Charitable Remainder Trust.
That's right, Charitable Remainder Trust. And it's a very complicated strategy. So it's more of an advanced strategy that we can use here at Retire Smart. It's what we call an advanced strategy, and it's not for everyone.
And I think it's just good to talk about, like, donor advised funds. I use that. I use Charitable Remainder Trust personally. Someday I hope to set up a foundation. So all three of those are valid depending on what you're trying to accomplish. But when it comes to the Charitable Remainder Trust specifically, exactly, it's not for the faint of heart. You need to make sure you dot your I's, cross T's. There's two main versions of that. There's what we call a CRUT or a CRAT, and we just put a U or an A between the R and the T, depending on what we're trying to accomplish. But it is a great strategy. You and I have actually worked on several high net worth clients' cases where we were able to provide them income. They had an income producing asset. We were able to replace the income, leave a wonderful gift, and get an amazing tax deduction. And in some cases, we can actually leverage that to enhance the estate plan. So these are amazing tools if you understand them, how to utilize them properly, which, again, if they come to your class, they're going to learn all about.
You can't do it by yourself either.
No.
You need help from an estate planning attorney to help set up the trust.
Well, not only that, exactly. We don't even do it all ourselves, right? We have a team of CPAs, attorneys, et cetera, that have to partner with us and the client. So this is one of those strategies you're going to have 4 to 6 people's hands in the pot the whole time to make it work properly.
That's right. Good job. All right, question number 2. This next question is about the IRS. Who knew they were so romantic? All right, what's the IRS's idea of a required, quote, love note when you donate over $250 to a charity? Is it A, a written acknowledgement from the charity? B, a copy of your bank statement showing the donation amount? C, a heart-shaped scented thank you card from the CEO of the charity? Sounds like they really appreciated that gift. Or D, an IRS Form 5498.
So you're going to need some written acknowledgement from the charity of the value of your gift. So we do a lot of donations, but also like we sponsor tables at events, right?
That's right.
I can't deduct the dinner part. I can deduct the part over that, right? So if in fact, we'll have a charity, we'll be coming up soon. It's $10,000 we'll sponsor. And we do it every year. We get a table, but the table is worth, I think, $1,200 or something like that, or whatever the deduction is. So I can only write off what's left, and I have to have a written acknowledgement from the charity that I did not get anything of value for that donation. In other words, the dinner, I got something of value, therefore that's why I cannot write it off, and why you want to have a written acknowledgement from the charity.
And the IRS actually requires different forms of documentation versus cash versus non-cash and the amount. So you want to make sure you get this right, guys. Anytime you're making a donation, you need to have that paper trail for your audits, because the IRS isn't big on romance, but man, do they love proper documentation.
And it's nothing to fear if the IRS questions something. People get nervous when they use higher net worth strategies, advanced strategies. Frankly, an audit is nothing to fear if you have proper documentation. Again, it's just them saying, hey, validate what you've put on your return, because just so you understand, you do not submit this information with your return. You know, you give it to your tax preparer, your CPA, your accountant, et cetera, your tax professional. They submit it. They've got the documentation. You should have a copy as well. But if they question something, all they're wanting is validate, prove, and it's usually no big deal.
That's right. All right, number 3. What's the tax smart way to send a Valentine's Day gift to charity straight from your IRA without paying extra taxes? It's kind of like sending flowers directly to your sweetheart without paying the delivery fee. All right, is it A, a qualified charitable distribution, B, bunching, C, donor advised fund, or D, pooled income fund?
So what we're talking about here is what we refer to as a QCD, a qualified charitable distribution. However, you need to be 70 and a half years old for this to apply, and it can only come from the IRA, which is what you stated in the question. Right. It cannot come from a 403B or a 401k or other tax-deferred account specifically from your IRA. The great news is if you've been blessed and successful in investing in that account, you can actually give away, if you choose to, up to $100,000 a year, lowering the value of your IRA, lowering future RMDs, requirement of distributions, lowering your tax liability, and blessing a wonderful cause.
That is a very sweet, tax-efficient way to send your love. I love it. All right,
we got time for one more. Give me one more.
Number 4. I think we can all agree that the song Endless Love by Diana Ross and Lionel Richie is the most romantic song of all time. Or maybe that's just me. Well, one way that you can show your endless love to charities is to leave a bequest in your will or trust, or name the charitable organization as a beneficiary on your accounts. What percentage of all charitable donations in the United States come from bequests? Is it A, 20%, B, 10%, C, 4%, or D, 16%?
I don't know this answer, but I'm going to take a guess of 4%.
I believe we have stumped David Brooks.
Got me. Dang it.
It is 10%.
All right. I didn't think it was 16 or 20, but
it really
10
surprised me as
like
well.
Simple, too round of a number for it to be accurate. I think you fudged it. Was it 9.75?
Yeah,
No.
we rounded, right? And that actually really surprised me as well. And
now, I also want to point out when you bring up the song "Endless Love," the memory just comes flushing back of Happy Gilmore. that's
friends
what
can
I
listen
picture,
to "Endless Love" in the dark.
Yeah.
Well, I don't know about you, but leaving bequest is can be maybe one of the 5 love languages in a way. And if you want to leave a legacy, I have a lot of clients that have children or grandchildren, and they're not divisible by the 100% when you leave that. So there's always this remaining 1% or 2% that they don't know what to do with.
It's a great strategy. Like if you had three beneficiaries and you want to give 33, leave 1% of your estate to a charity, and that makes you don't have to make an odd number. And because some places you leave money will not take fractional beneficiaries, you can't do 33.3. You almost all these custodians where you may have your investments held are going to want round numbers.
Round percentages.
You bring up a great point of a way to do that is just use a charity is to round it off. And a lot of folks, your church would love to talk to you about this. In fact, they may even pay for some legal paperwork to be drafted if you make it irrevocable, the gift that's going to get to them at some point.
That's right.
All right, hey, listen, we are out of time. This was fun, and you got me. So you got me this week. All right. So tell everybody again, when is the class so they can learn this and so much more?
Yeah, absolutely. Once again, it's called Strategic Charitable Giving, and it's going to be February 12th, 6:30 p.m. right in the Midwest Learning Center.
All right. Give us a call at 402-369-7777 or go to the website and get registered. Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell, and I've got a little extra giddy up in me now. We finally did stump David Brooks. It had been a while. So all is right with the world. All right, into the Q&A we go. David, the first question is about Medicare. I turned 65 this year and am still working. I'll probably work until I'm 70. What is the rule about Medicare? I really don't need it until I retire because I still have health care through my job. Should I switch to Medicare? Can I do that if I'm still working? What's the story, David?
Okay, so what's going to happen at 65, typically automatically Medicare Part A is going to kick in for you, and your employer is going to make sure this happens, by the way, because then they don't have to pay if you were to be hospitalized. But absolutely, you could continue with your health care at work. However, it may or may not be the right decision. There's a lot of factors that go into that. So real quick, Medicare Part A, you do not have to pay anything for, right? There's no out-of-pocket cost or no premium, if you will. You only would pay a deductible if you go to the hospital, but that's what you've been paying through payroll deduction your entire life for. Medicare Part B is basically the outpatient stuff, going to the doctor, getting your screenings, et cetera, and that is what's typically going to be covered by what your major medical is now covering. However, what we caution people, like, I can just keep the healthcare at work. Yes, you can. However, sometimes it's significantly cheaper to buy a supplemental policy because here's what happens, Chip, is your major medical is typically going to have a large out-of-pocket in today's world, like $7,500 a year, right? In other words, you might have to pay the first $2,500 to $7,500 out of pocket every year, plus you're paying for it through payroll deduction, whatever percent you are paying. The average employer in America pays 50%. Bigger employers typically pay higher. We do. We pay over 80% of the expense for our employees on the benefits we provide. So if you're paying 20% out of pocket, let's just say that's $200 a month. It was $1,000 a month if you're 65 for the group health plan, and that's probably cheap, frankly. Then you still have to go pay that out-of-pocket expense. If you went and bought a supplemental policy, like here in Nebraska, it's only about $118 for the best supplement you can buy, which is called a Plan G, and it has zero out of pocket, except the first $200 a year, $233 or whatever the Part B was called Part B deductible. So you could actually save $3,000 to $4,000 a year by switching if that were, but again, we don't know you're out of pocket, all this, and that's why I would recommend coming to our ABCs of Medicare class.
It's not a one-size-fits-all proposition.
And by the way, we have some outside vendors. We help place Medicare policies with our clients and one, but we do teach an amazing class, and Miles Morrissey, one of our advisors, does a fantastic job. So I would recommend you go there, but the option is there if you want it. So you just investigate it before you decide to stay on your plan, because your employer would prefer you go on to Medicare because you're going to save them money. You're taking one expensive body like Chip, not to put it out there,
it's
but
me
you're
in
one
3
of
years.
You're one of the more expensive people on our plans, right? Because you're older than I am, clearly.
Well, this is me in 3 years. I'm 62. So what you're saying is at 65. So would it be a total switchover, or is it some kind of a hybrid thing where you're partly covered by Medicare and partly by
And the answer is it depends, but all the above are possibly true.
All right. Well, as I say, this may be me in 3 years. On to the next question, David. This is about adult children. Well, actually, this also applies to my life. The question is, my husband and I are retired in our early 70s. We have 3 adult children who are struggling to make it. We want to help them financially, but we also want to make sure we don't jeopardize our own financial situation. Do you have many clients who face this challenge of wanting to help adult children without wiping themselves out?
Absolutely. In fact, we have one client that is helping their adult children and is wiping their own savings out against our advice, et cetera. And it can become a very tough thing because emotionally you want to be there and provide. But at some point you have to tell the children, we have to take care of ourselves first because no one's going to lend you money for retirement. I'm sorry. There's no loans for retirement. You get loans for a lot of things, but for income, for retirement, no. So I would caution you before you go help them, seek professional advice. And again, it doesn't have to be our firm, but you should sit down with somebody that's an independent fiduciary-based advisor to objectively look at what's going on and help you understand. Number one, sometimes you can pleasantly tell people, and we're able to do that, you can help them to the tune of X amount per year if that's what you so choose and not harm your retirement. But if you don't have a plan, how would you know? So you need an inflation-adjusted written income plan. We need to know where all your sources of income coming from, guaranteed, non-guaranteed, et cetera, what the volatility in your portfolio might do if you had to pull more dollars out. And with a simple, I call it a simple plan, but a well-crafted our smart planning process plan, we could very easily dial in, hey, if you want to give away $15,000 a year to help your kids or whatever the number is, so be it. Go for it. And then a lot of other clients don't want to give it away because they don't want to enable those children. And I can tell you, I have 2 adult children, and they both financially still get some form of assistance from me. And that is Society Day, too, just so you know. So if you're a 25-year-old today, it costs you 480% more than when I was 25 to go out and get an apartment, pay your bills, et cetera. And wages are not up 425%. They're up about 180% over that time period. So it is tougher for them. Let's just face it. That's just the economic situation we're in. So you don't necessarily need to feel bad that you're helping, but wouldn't you want to know if you could, how much you can, and structure it in a way where you can wean them off, give them some goals, et cetera. Now, if they're just frivolously spending, and then you're going to have to cut them off. So, I mean, there's a lot to that, but you should seek professional advice.
Well, and you recommended finding a fiduciary-based advisor. We throw that term a lot around. Every once in a while, David, we probably ought to explain what we mean by fiduciary.
That's just a funny word we like to say. No, it simply means that the advisor, it means a couple of different things, but basically the root of it is they are legally obligating themselves, and we do it through a contract. When you hire us, we are signing a contract to tell you what's in our best interest, what's your best interest, the client's best interest, even if it's not financially in our interest. Now, the other thing is we need to disclose to you if there were something we were telling you advice that could be a conflict of that interest. In other words, we were just talking about the first question, Medicare. If you bought a Medicare policy from our vendor, we receive a small piece of the commission back as a revenue source to the firm. Well, by me making that recommendation to you, that could be a conflict of interest. I'm going to get paid some kind of money. It's not a lot of money, just so you understand, maybe $15 or something each month, but that is a conflict of interest, and it should be clearly disclosed to you when we have conflicts of interest. All of our advisors are fully licensed on the insurance side, health insurance and life insurance, because we might need estate planning, med sups, Medicare, all those things in a true holistic plan. But when we earn that dollar, you didn't pay us, but we earned it. So that absolutely is what we call a conflict of interest. And I'd love to tell you, you can eliminate 100% of them. There's people that claim you can. You can't. What we need to do is tell you what's in your best interest and be transparent about it. It's a great point.
Stock options, David, that's the next question. My company is offering stock options. What does this mean to me? How do I get compensated for the stock options? Will I owe taxes?
Well, the last part's easy. Most certainly, probably yes, right? Not all companies are going to give you a tax-free option. So stock options come in many forms, so we don't have enough information here. But typically what happens is you are given options, and my old employer, which is my first employer in this business, Payne Weber, we used to earn them through incentives, what have you. So if you get an option is a unilateral contract for the right for somebody to be able to take possession of the actual stock. So you can get stock awarded or stock options. And again, the stock options would only be in value if the stock was above what's called the strike price. So just so you know, my old employer, Payne Weber, got bought out by a company called UBS, Union Bank of Switzerland, one of the larger, what's called wirehouses in our industry. I have stock options. They're still underwater from 2000 when the merger took place. But I was given options when the merger took place at this high price point that has never been exceeded. So these options are worthless to me now, but if I did cash them in, they would be taxable to me. So great question, and it's a great way for companies to incentivize you. In other words, if the company does well, you will do well with these options. That's the idea behind it. So a company that has stocks that's continually rising steadily over time, this can be an amazing benefit, but absolutely be taxable to you. And again, seek professional tax advice before you make your decision on how much of those you want to accept, if it's something you get to choose.
Up next, the Securities and Exchange Commission has shifted its rules on cryptocurrency. We look at that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, I do want to get to the shift in crypto regs by the SEC, but actually this may tie into it. I want to shoehorn in the story. We weren't able to get to it in the first segment, but the Fox Business headline is Trump launching U.S. Sovereign Wealth Fund. Trump White House says the sovereign wealth fund will help maximize the stewardship of our national wealth. This is something we have talked about before. There are some states, I think there are 90-some countries that do this. Explain to us this phenomenon of the sovereign wealth fund and what Trump wants to accomplish.
So a sovereign wealth fund is an awesome idea in general. And you're right, there are over 93 countries currently around the globe that have sovereign wealth funds. So Norway's the largest that I know of. It's about $1.3 trillion that they have, $1.3 trillion. Now, we have 20 or 21 states, I believe, currently in the U.S. that have sovereign wealth funds. And what the idea is that you build up an investment account, and then you take a reasonable distribution, like a 3 to 5% distribution off of the account every year, and use that to help fund your government, right? And you can give out better service. I mean, Saudi Arabia, they've been doing it for years, right? Now, the difference is most sovereign wealth funds, including the ones here in the States, the largest three, I believe, are Texas, New Mexico, and Alaska, and I'm not 100% sure in which order, but we know Alaska and Texas are probably funding that through oil coming out of the ground, natural resources, right? So you take some of just to scrape a little off the top of the profit of the resources you have at disposal, and that's what Norway does, by the way, with oil, et cetera. And you invest it over a long period of time, and if you invest it well, you can grow the value of that fund, meaning more benefits that you can give to your society. And so Norway made $260 billion in profit on their wealth fund last year. So now it's going to continue to climb and grow. And so if they have a 20 or 30% rate of return in a given year, they don't up their distributions. If they're only distributing 5%, now next year's 5% is significantly higher, over 20% higher. Saudi Arabia pays for it. So why not? And I don't think you have to do it just from resources, by the way, which is how most of them are funded. I believe, look, what are we paying for our debt right now? Just so you know, the average debt in America that the U.S. has financed is $36 trillion, is sub 3%. Now, it's going to start rolling up about 100 basis points because the interest rate's a little bit higher. But what is the S&P return, Chip? I know this isn't your mantra. Over the last 100 years, what do you guess?
I don't know, 10%?
That's pretty close. So let's just take 10%. So if we can invest for the long term of the country, and we want to be here for 100 years for sure, right? And we can average 10% in that investment, why wouldn't we take 1 or 2% of every dollar gathered in revenue and invest it? In other words, that's an arbitrage positive to the American taxpayer. If we're earning 10% and we're paying 3%, that's a 7% gain for the taxpayer. And over time, as that fund builds up, eventually we can use the fund to wipe out and retire 100% of that debt. Now, it will take some time, but I think it's a fantastic idea, and it's long, long overdue. Wouldn't you rather have a sovereign wealth fund in the future instead of a debt? But the central banks want to enslave the world in debt. Yeah, it's a fantastic
our interest
idea.
payment now, as you've noted numerous times, we're already north of $1 trillion a year, right, in our interest payment on the debt.
Yeah,
so if it could be a vehicle for debt reduction, I could get excited about that.
And it's very easy to set up, and you're going to need Congress to vote this, and you're going to need bipartisan support. But again, that would require logic, and we don't see a lot of that on Capitol Hill. But anyway, all right, let's move on because it's a great idea, bar none.
Well, let's move to the info that you shared with the team about this shift in cryptocurrency regulations at the SEC. You also mentioned it in connection with a podcast. I think it's called All In with David Sachs and other financial leaders in the industry. You mentioned an episode with Ray Dalio, the chief investment officer at Bridgewater Associates, in connection with this. Sort all this out for us, David.
Well, this actually kind of ties into what we were just talking about, the sovereign wealth fund. So crypto assets, Bitcoin in particular, could be something that would be purchased by the federal government, and Trump has talked about, and then placed in this sovereign wealth fund. And so the value of those, if the Bitcoin continues to go up in value, which there's a lot of people thinking it will, including Ray Dalio, then that could be a way to earn the gains against us. It's a digital store of value. We come to our class on that. Brad, our advisor, teaches on. But crypto is going to be a much friendlier asset to own under this SEC versus the previous. Gary Gensler, the former head of that, was he brought cases and fraud cases against people where now crypto is going to be very, very pro. This is going to be a very pro crypto administration. And so that probably bodes well for the value of some of these assets. Now, I need to make sure people understand, this is why we have the class, by the way, that Brad Starkin, one of our advisors, teaches, is meme coins, these coins that are just made up, or somebody's anybody can launch a coin, right? And they're various, they have no value. That's just extracting money from somebody. You're selling them and pulling the value. But ones that are limited supply, like Bitcoin is, there's only going to be 21 point whatever million coins ever mined, the way the math works. That is why intrinsically will probably have a higher value over time. Now, I personally invest in several pieces of cryptocurrency or digital assets, whatever you want to call them. However, I would caution people, some of those assets out there are extremely speculative, and you need to understand the taxation and ramifications of this. But it is going to be mainstream, so you probably should have a discussion with somebody. Maybe you should have some small exposure in your portfolio. We have one of our portfolios that does that for some of our clients, but again, it's not for everybody.
David, CNBC headline reads, "A record number of consumers are making minimum credit card payments as delinquencies also rise." And maybe this is somewhat related. Just before we sat down to do this radio show, you shared with me this item on job openings declining rapidly. Some ominous indicators?
Yeah, again, I've been talking about this for a while. Jobs are being cut everywhere. We're starting to see it mount. It's still not accelerated to the point where you're going to have the reflection signals fire off. But I believe if you're going to see the Federal Reserve cave into Trump's wishes, which he wants lower interest rates and cut, they're going to need to see unemployment rise. And we're starting to see that. It's gradual. But by the second half of this year, I assume we'll see about a 50 basis point hike in the unemployment rate. We're currently sitting around 4.3. So if we go north of 4.8, 50 basis point move gives them the credibility to start cutting interest rates, because remember, they have a dual mandate, inflation and full employment, and they'll use the employment as their excuse to be able to cut rates. And I'm telling you, they want to cut rates desperately. I just don't think they can with the inflation numbers we have right now. So in the second half of the year, I think the flip will switch, the switch will flip. Listen to me, flipping my words. And you're going to see some probably aggressive cutting potentially in the back half of this year, because we have to finance $9.6 trillion this year. Do you want to finance it rates up here or rates down here, right? And so it'll happen one way or the other. And if we get the market to sell off, the valuation's a little high. If we were to have a severe correction, you have what's called a flight to safety, flight to quality. So when people sell stocks, they typically transfer that money into treasuries. If a bunch of money, trillions of dollars goes out of stocks and into treasuries, that will suppress the yields drastically. And again, that's when you'd refinance the debt. Again, I think Scott Bessert is one of the smartest people on the planet. He knows this, and unfortunately, that probably means we're in for a decline in the markets here in the next 2 quarters at some point.
You're talking about the new Treasury Secretary.
Yes.
Yeah. Well, okay, so, I saw a headline in preparing for the show about fewer Americans quitting jobs than ever, like since the pandemic or something. And at first I thought, oh, well, that's good. But then as I looked at the story, well, it's not necessarily that they're loving their jobs. They're scared. They're hanging on to what they have. There are fewer job openings, as this chart shows, and maybe they're also having trouble keeping up with their credit cards.
And I don't have
so
the final numbers, but we had well over 20,000 people resign from the federal government based on the buyout that was offered to them. Mm-hmm. And as of this morning, when we're recording this show, the CIA's employees were all offered the same deal. As of today, they've got about 10 days to make a decision. And so you're seeing a lot of change here. We didn't even get a chance to talk about the U.S. aid story and how much nonsense and spending has come to fruition. So again, if anybody's against this frivolous spending stopping, then you got to question what are they really doing. And so again, pay attention. There's going to be a lot more change. We're going to break some eggs fixing where we are right now. And so I fully expect a lot of disruption in the economy, but we're going to be better off on the other side of whatever's coming.
All right. Meanwhile, when it comes to your portfolio, David, here's a Market Watch item. Trump, tariffs, and your 401k. Why it's time to diversify. Well, okay, that's a mantra that's repeated often. Don't put all your eggs in one basket and so forth. This article, David, talks about something called the all-in, no authority strategy. What is that, and do you subscribe to that?
So people are going all in on these passive funds, in particular in tech, and the retail investors as fully invested as they've ever been. Yet we're seeing the large hedge funds institutions back off right now, and that's typically tells us the market is closer to a top than not. And again, we'd have no great way to predict or tell you what's really going to happen. But a word of caution, exactly. Don't get crazy caught up in the hype, et cetera. And I've had clients, they just think the world's going to be set on fire. Trump won and it's going to be great. They're going to cut taxes or we're going to have no taxes. Look, there's reality and there's rhetoric, right? And we've got to decipher the two. And we're going to react in real time for our clients, but be proactive. Make sure you're not taking unnecessary risk at this point of all-time high valuations.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and great week. That little spring fake out from a week ago is long gone. And stay warm.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.